Hello, personal finance gang. Oh, I didn't want that on the screen. Hey, personal finance gang. Sorry we aren't in class in person. I would have much preferred to have had class today versus having all this shutdown stuff for months. But anyway, we've got what we've got, so I'll be putting the rest of the semester online, as I said, and this is the first of those. We already did a little bit of this life insurance topic before spring break, but I thought I'd just rewind and start from the beginning. So, well, I guess let's go ahead and start talking about life insurance. And, well, I'm coming to you, I should mention here, I don't usually wear my hat inside, but I'm just coming to you with my river hat to give us a little river flavor to the experience. I'll send you some river pictures. I do have some pictures from last week. I did have some time on the river where I didn't, or tried not to think about other stuff. And I got a few good pictures and I got a nice video of my wife that somebody took that I'll send you guys. But anyway, so let's get back to life insurance. So we're going to see a few, or try to answer a few basic questions. Should you buy life insurance? Sometimes the answer is yes, sometimes the answer is no, sometimes the answer is maybe, and the answer will depend on where you are in your life, we'll see. We'll also talk about what are the different types of life insurance, and as usual, I'll have an opinion on which ones you should and shouldn't get. And we'll also talk about how much life insurance should you get. So insurance, we've talked a little bit about insurance already, but insurance is designed, the whole point of insurance is to reduce your risk of financial loss. So this is all, our class is all about personal finance, using your money wisely. Another thing we want to do is protect ourselves from losing money from unforeseen events, such as, well, we're facing right now as an example of an unforeseen event. But with insurance, we try to reduce our financial risk. Where does that risk go? Well, we know that risk goes to the insurance companies that sell us the policies. So we're transferring risk to insurance companies, and that means they're taking on our financial risk. They're accepting our financial risk, and they'll cover us in the event of certain losses that we'll specify based on the policy and such. Now, we're unwilling to, or we don't want to take these risks ourselves. Does that mean the insurance company itself is gambling by taking on the risks? The answer to that is actually no, because the higher the probability of a financial loss, the higher the cost of the insurance. So insurance companies, while it might look like gambling, are generally pricing their policies based on expectations and probabilities, and pricing them such that they have a little bit of a cushion in there and that they also will make a profit. Now, we've done this before, but here you are, you're suddenly the head of an insurance company. So you're all insurance company executives. Who would you charge a higher rate for life insurance? So life insurance is insurance that pays us in the event we die. Well, pays whoever we name in the event we die, because if we die, we aren't collecting, obviously. But who would you charge a higher rate for life insurance? Men or women? Well, I'm betting most of you picked men, and the reason for that is clearly because men are dumber. but also because men have shorter life expectancies. So the odds are in any given year that men are more likely to die than women, so we're pricing based on probabilities. We would charge men more. Again, men just tend to do more stupid things. So who would you charge a higher rate for life insurance? An old person or a young person? Well, in this particular case, with that particular young person I have in this picture, it might be debatable, but we know that, well, we have certain life expectancies. Everything else equal, the older you are, the higher the probability of you passing on. So old people should pay more for life insurance. An easy one here. Who would you charge more for health insurance? A smoker or a non-smoker? Of course, we know that smoking is linked to all kinds of health issues, and this particular smoker looks particularly unhealthy. But smoking means higher probability that the health insurance company has to pay for your health-related diseases, so they would charge you a higher rate if you were a smoker. Don't smoke. You're the head of an insurance company. What happens to the risk of someone who's been diagnosed with cancer? What happens to the risk of life insurance for someone who's been diagnosed with cancer? Would you sell someone who'd just been diagnosed with cancer a life insurance policy for the same price that you would charge for someone who hadn't been diagnosed with cancer? Well, remember, insurance companies have to price their products to where they make money. So the higher the probability that they have to pay out, and with someone with cancer, there's a higher probability that they would die. So insurance companies would obviously have to charge them a higher rate. Think fast. What do we call the cost of insurance? I'll see this again, but we've seen it already. That's the premium you pay. So you're higher the chance of loss, the higher the premium you'd have to pay. Let's say we've got an insurance company that offers a dental policy and it pays 100% of the cost of braces and crowns and such. I've had to have a few crowns, unfortunately. Who would sign up for an insurance policy that pays 100% of these costs? Well, this particular guy in the picture might not sign up because he's not going to get many crowns or braces. But in general, if I knew I needed a crown, hey, let me have that policy that's going to pay 100% of the cost. So people who have dental problems are more likely to sign up for this particular policy. So given that this particular policy is likely to attract people with dental problems, what's going to happen to the cost of this policy? Well, this is going to end up being an expensive policy because we know mostly people with bad teeth are going to sign up for the policy. And since this is going to be a high-cost policy now to cover all these problem cases, if you didn't have any dental problems, would you sign up for this plan? Well, you'd look and go, geez, this is pretty expensive. I don't think I'm going to need a crown or braces, so shoot, I don't want to pay for this expensive policy. So what ends up happening with this policy is what's known as an adverse selection problem. Only the people who have bad teeth will sign up. And so this is definitely going to be a really, really expensive policy. Now, what if we're back to being the head of our insurance company and we get a call and it says, man, my house is on fire. I need home insurance right away. Would you sell them insurance? Well, obviously not. That would make no sense whatsoever. So there you are as the head of an insurance company, and you know selling insurance when the house is already on fire makes no sense. Now let's fast forward just a tad, and you're the head of the insurance company, and someone comes and says, geez, I have cancer. I need health insurance. Would you be keen about selling them a policy? Well, obviously not in this case either. That's what's known in health insurance lingo as a pre-existing condition. This is something you had wrong with you before you bought health insurance. There's been a big push, and right now it actually is the law, but that may change, to where insurance companies have to cover pre-existing conditions. Does this make sense? Not unless other things are going on, which in this case right now those things are on hold because of lawsuits about the national health care law. But with a pre-existing condition, if you sell a policy to someone who has, say, cancer, and you agree to cover all their health insurance costs, well, geez, you know right away the chance of loss is higher, and the cost of that insurance is going to be a lot higher. And actually what insurance companies would do is refuse to pay for your pre-existing condition if they could, but right now the law doesn't exactly allow for that. So covering pre-existing conditions doesn't make sense for an insurance company unless we have some other things going on. One thing that the health insurance law, also known as Obamacare, did was required that everybody have health insurance. If everybody has health insurance, then we don't have to worry about them going, hey, I'm going to wait and sign up when I'm really sick, and then, hey, they've got to cover me. But right now, the insurance mandate is not in effect. So forcing insurance companies to cover pre-existing conditions doesn't make sense at the current moment. So some terms we saw one of these already, but premium, we know that's how much you pay for your policy. But new to life insurance is the beneficiary. Obviously, if you buy life insurance on yourself, you're not going to be collecting that. So life insurance pays when you die, and you name who would get paid in the event of your untimely demise. So that's your beneficiary. My spouse, my wife, is my beneficiary. You can name different people to be beneficiaries. You could name your favorite charity or whoever you wanted. You could have your insurance policy payments split between people. And you can also have what's known as a contingent beneficiary. So that's who would get paid in the event your beneficiary isn't around. I've got that term coming up later. My daughter would be my contingent beneficiary. I know you needed to hear that. So yeah, in the event I would die, my spouse would get paid, and then if my spouse and I were lost together, then our daughter would collect. So life expectancy, well, this is obvious. How long do you expect to be around? That insurance companies price life insurance based on life expectancy factors. So the older you are, the shorter your life expectancy. If you're a smoker, have bad health conditions, you're obese, etc., you would have a shorter life expectancy, everything else equal. And that's how insurance is priced. So males have shorter life expectancy. They would have to pay a higher premium. and older people pay higher premium, etc. So, should you have life insurance? You should have life insurance if someone is financially dependent upon you. So that's the primary reason to have life insurance. You have someone who would be in financial need if you weren't there to provide for them. People have life insurance for other reasons. Maybe they just want to pay off their mortgage when they die. Maybe they want, hey, I want to have a big estate payoff when I die. I don't, maybe nobody's financially dependent upon me, but I want the heirs to have a big payout. Some people leave money, life insurance policies, they have their charities, their favorite charity, as their named beneficiary. So this is the a kind of personal values section here. Obviously, if you're paying for life insurance, this is money that you could have spent now. You could have done all sorts of different things with the money you spend on life insurance, but you're deciding that it's more important to you that your family or loved ones, whoever this may be, is taken care of when you're not around anymore. So obviously this is a payout you will never collect or never see, but you think it's worth making for the happiness or, financial well-being of your family or loved ones down the road. All right, so let's do a few examples. So we've got Mary Jane here. I have a friend named Mary Jane, so we're not talking about marijuana there. But anyway, Mary Jane is 24. My friend Mary Jane is older than 24. But that has nothing to do with this Mary Jane. But anyway, so Mary Jane is 24, single and carefree. She gets insurance through her employer. Many employers do provide insurance. Depends on the employer. And they give that to you just as a benefit with little or no extra cost. Sometimes you can buy extra through your employer. But anyway, so Mary Jane is making $36,000 a year. Her employer gives her insurance equal to 1.5 times her annual salary. So she's got $54,000 in life insurance just through her employer. Right now, she owes $15,000 on her car and $12,000 in student loans. Should she buy additional life insurance? Well, this case, who's financially dependent upon Mary Jane? Well, no one. Obviously, people would be sad if she died, but that's not what insurance is about. This is about a financial need. So, in this case, if Mary Jane died, her employer would pay $54,000 to whoever she named as a beneficiary, and that would be more than enough to cover the loans that she has outstanding. So Mary Jane has no need, just based on the pure financial analysis here, for additional life insurance. We would say, hey, Mary Jane, take your money, save it towards retirement or some other financial goal you have. Now we've got this nice couple here, Emma and Lou. They're married and in their early 30s. They're both working professionals, well paid in their fields. Do they need life insurance? Well, this one I put maybe, maybe not. We'll come back to this case here. So it kind of depends. I've said they're both self-sufficient, working professionals. If either one or both, both of them could get by financially, of course they'd be disappointed and sad, but if they could get by financially without due hardship, if the other one passed, they might not need life insurance. Or you might get enough life insurance just to cover funeral expenses. Or you might want enough life insurance to pay off some major debts or half the major debts. But again, we'll come back to this one here. So maybe they do, maybe they don't. Now we've got Jim and Sally here. They're married and in their early 30s. They have, well, not early 30s, they're late 20s. I don't know why I said Emma and Lou were in their early 30s. They have a 1-year-old daughter named Ginger. Of course, you needed to know that. And Sally is the primary wage earner while Jim stays at home. So should the family get life insurance on Sally, the one who's out making the money? The answer there is definitely yes, because there is a pure financial need for Jim and Ginger should something happen to Sally. So we definitely do want insurance here for Sally. This could cause some financial hardships on the family or the remainder of the family if Sally should pass away. All right, so we've still got our Jim and Sally here, and we know Sally's the primary wage earner and Jim is the stay-at-home dad. So should we get insurance, life insurance, on stay-at-home dad Jim? This one's a little trickier there. We got maybe, maybe not. So it depends. If Sally makes enough money to where, hey, if Jim's gone, she can still pay for daycare, etc. for Ginger, then maybe we don't need it. But if paying for daycare would create a financial hardship, well, then maybe let's definitely consider getting that life insurance there on Jim, because he is providing a valuable service as the stay-at-home parent. He's watching the little one who would have to be in daycare, or we'd have to find another family member or whatever to watch her. Jim probably also cooks meals so they don't have to eat out as much, etc. We want to take all of that into account when we're trying to decide on coverage for life insurance coverage for Jim. Now, Ginger, I got a haircut today. Well, actually, I gave myself a haircut today. I know you needed to hear that detail too. But Ginger, keeping my river hat on, Ginger, the little 1-year-old, should we get life insurance on her? This one is much easier in my book. No. Okay, there's not going to be much case here where we're going to actually need life insurance on Ginger. Maybe we want a policy that covers the cost of burial, but I don't even think we want that because, well, what are we going to have instead? Well, one, the odds of Ginger dying are really, really slim. We're going to watch this kid like a hawk. So hopefully nothing's going to happen to her. But if in the unlikely event that something did and we needed to cover the funeral costs, what do we have? We've got that emergency fund set aside. So, I mean, I think that's probably sufficient for our needs, financial needs related to Ginger. Now, Ginger there looks pretty cute, and if she was a model and we were, she was providing income for the family, that's another thing. But again, we would be devastated if anything happened to Ginger, but that's not the same as a financial need. So we get life insurance if there is a financial need in the event, financial loss in the event of that person's passing. Okay, now here's a sales pitch you might hear. So if you get Ginger's life insurance now, you can lock in her policy at a low rate. And suppose Ginger turns 18 and she's unable to get life insurance because of some health issue. Yeah, that's not an issue. You've locked her in now. In this case, should we get Ginger life insurance? Well, the answer there is, yeah, whatever. That's a sales pitch that you might hear from insurance people to get you to buy a product you don't need now, so that you might be able to get it or can have it when you still probably don't need it or want it down the road. And odds are, if you did need it down the road, you can get it then. Why pay for something for 20, 30 years because you might need it later on? Odds are you'll be able to get it later on. So that's just a sales pitch you hear to get people to buy insurance that's very profitable for the insurance companies, because not very many little kids have issues. All right, now we've got Jim and Connie. They're both 65 years old and retired. They just retired this year. I don't know, they look maybe older than 65. But anyway, so they're 65 because I made them up. And their kids are grown. They've got a lot of money already saved up in retirement. And they've got enough money there so that they can live together independently or whatever. Do they need life insurance? The answer here, well, life insurance provides for a financial need. They've already got money saved up in their retirement accounts. They're what you guys want to be. They're multimillionaires. I just added that bit of info here. They've got plenty of money saved up. So I made them multimillionaires. But they've got plenty of money saved up, so they don't need this life insurance policy. Worst case, maybe you get a policy that covers funeral costs, but I think I would, if they've got enough money saved up, they've got cash sitting nearby for emergencies, and it would cover that. So this couple would probably not need life insurance. So let's say you do decide you need life insurance. How much life insurance should you get? Sorry. Let me get a sip of tea real quick. I'm running low on that. Oops. So you do need life insurance. How big a policy should you get? Well, it depends. Sorry, I didn't have enough tea. It depends on how old you are, how old is your partner, do you have children? Of course, children is a big need for health insurance. Then how old are the children? So, my daughter's 24. She doesn't come into the financial need picture anymore for me, versus when she was 4. That's a totally different issue. Then we have, does your spouse work? If your spouse works, that's money that's coming in, so you don't need to provide for everything. And then, of course, savings. So if you've, like Jim and Connie, who we just looked at, they're retired with plenty in their retirement account. They've got enough saved. Bill Gates, a billionaire. What's Bill Gates going to need life insurance for? So, but for the rest of us, we do need to look at some of these other factors. So if we've got a spouse who stays at home with the kids, how much life insurance do we need for them? One suggestion would be, hey, take a dollar amount and multiply it by how long until the youngest child would turn 18. That's one suggestion. You could also look at, how much would our daycare costs be? Look at daycare costs for a period of time. Look at after school care for a period of time. Estimate those and try to come up with a better figure than just using an arbitrary number and multiplying it times the number of years. But you want to come up with some estimate for how much extra costs will the surviving spouse have to pay because they no longer have that stay-at-home spouse. So there are online calculators that can help you with this, or other things that can give you a rough estimate of these. So you try to work out roughly what you would need to pay if that spouse died, and then factor in how long you're going to have to be paying that for. Now, I mentioned this, we had Emma and Lou before, but now we've got, a different couple here. We're both working and we don't have kids. How much life insurance should we have? Well, one way to estimate this is figure, hey, we want life insurance to cover funeral expenses and then half of our joint debts. So if we've got a mortgage loan for $200,000, maybe each spouse gets a $100,000 policy to cover that half. If we've got car loans, half the car loans, and then funeral expenses. So you figure out what are your rough expenses, or what rough loans, and maybe any other expenses that might pop up. Factor in your percentage allocation between each partner and get policies based on that. So if we're living in a house and we're paying a mortgage right now, and if something happened to the spouse, one of the partners or spouses, we would not necessarily want the other one to have to sell the place because they couldn't afford to pay for it. So getting that insurance that covers at least half the cost or some prorated portion there makes sense, and that surviving partner can continue to live in the house. Okay, so that's one way to come up with an estimate of how much you'd need if you were a couple that didn't have kids. So again, life insurance kind of changes over time. Let me see if I have this. Oh shoot, that's not what I was trying to do. I was having microphone issues earlier. I thought I had this already. Yeah, I do. That's not what I wanted to show. Okay, so yeah, I wanted to show you this video here on, it disappeared. Let me try this instead. Alright, so here's a quick video on...
When should I buy life insurance and how much coverage do I need? The ideal time to buy life insurance is when you experience your first life-changing event. For example, when your family grows, as in marriage, or when you enter into a long-term financial commitment, such as a mortgage. As you go through life, other events will require you to review how much coverage you have, and either increase or decrease it. For instance, with the birth of a child, when you buy a larger home, or when you get a promotion and can afford a better lifestyle, your coverage requirements will increase as your financial responsibilities towards your loved ones grow. If you are using insurance to protect your savings, for example for your children's education, you might choose to increase your coverage as they grow up and decrease your coverage when your children become financially independent. The amount of premium you pay will rise and fall depending on these adjustments. The key is to review your insurance requirements regularly, at least once a year, to ensure you have the protection you need. This will also protect your policy against inflation. There are several ways to calculate the amount of protection you actually require. One approach is to look at your income. Multiply your annual income by the number of years you would like to be protected. This could be until your family or children are able to establish their financial independence, or until you retire, if you want to give your dependents longer-term protection. Alternatively, you could base your requirements on a forecast of your family's expenses over those years. If you choose this option, remember to include future expenses such as school and university fees. It may be possible to offset some of these expenses against your partner's salary if they work. At the very least, you need to provide enough cover to pay any debts or costs you might leave behind. If you want to work out your requirements for yourself, you can find plenty of information online to help you. You may be surprised by the total amount of protection you need, but remember, this is not the amount you will need to pay. Indeed, your premium will be quite small by comparison, so there is no need to panic. Once you know how much cover you need, it will be time to choose an insurance provider and a product which is right for you.
Okay, well, sorry I did such a lousy job of getting that in the middle of the screen. I didn't practice that.
The pros and cons of saving and investing.
Obviously.
Imagine.
Obviously. So let me drag that off screen and go back to screen here. So anyway, that's, there are different ideas on how to pick how much insurance, life insurance you need. And you want to do what's best for you. So you go on here. All right, so this is one of the things mentioned in that quick video. How much does your family need? So you could go through and try to estimate those needs. And then you could figure out what resources your family had. So savings, as a partner's salary, etc., other life insurance policies, maybe you have a policy at work. And then the difference between the family needs over a period of time versus what you can what they can already get, and that would equal your insurance needs. And there's a video here on this. I've got the link on your PowerPoint slides that you could check out. I'm going to not do that one. I like this first one more. But yeah, you still might want to check that one out. All right, so back to this truly cheerful topic of life insurance. We have this woman here whose husband died, and she's going to be getting a $1 million life insurance policy. Will she also be getting a big tax bill? This is a surprising answer: no. Most insurance payments are not taxable events. They're just, you're recouping a loss, basically, so you're being made whole and not supposedly not gaining anything in the process here. So life insurance generally not a taxable event. And that's where we're going to pause for this episode. And when we pick up next time, we're going to talk about different categories of insurance. We've got term insurance, whole life insurance, and universal life insurance. But that'll be in the next episode.